Welcome to Exploring AI Matters. This podcast series, previously known as Mind the Gap, Dialogues on Artificial Intelligence, will continue to appear in the ABA series to the extent that. In addition, all of the episodes, old and new, will now appear under our new podcast name, Exploring AI Matters. Thank you.
In our previous episode of Mind the Gap, Dialogues on AI, we explored with University of Toronto economist Avi Goldfarb the use of AI as prediction machines in commercial contexts. In this episode, we will focus on consumer lending because many of us apply for loans to finance things like education, cars, or homes. We will look at the use of AI by financial institutions and financial technology or fintech firms to predict the creditworthiness of applicants for consumer loans and, if granted, the pricing of loans offered to them. Our guest today will be Columbia Law professor Talia Gillis, whose article, The Input Fallacy, published in the Minnesota Law Review in February of 2022, explores the benefits and drawbacks of using AI to predict creditworthiness and determine loan pricing. The growing use of AI in credit decisions expands what is considered creditworthiness data and how it gets used. Credit criteria like FICO scores traditionally used only loan payments to large and established financial institutions to determine creditworthiness. But as Professor Gillis's article points out, lenders now use AI increasingly to assess non-traditional data inputs not generally available in credit files, including information on the applicant's education, and digital footprint data, such as the device and operating system a consumer uses when visiting an online purchasing site. While AI-generated alternative credit scores have proved in many instances to achieve improved accuracy in predicting creditworthiness, AI does not uniformly generate improved predictions. It is also not clear whether AI can reduce the occurrences of discrimination in lending practices. To help us break down the challenges in AI's use of high dimensionality data in the consumer loan context, we are fortunate to have as our guest a scholar qualified as a computer scientist, a lawyer, and an economist. Professor Gillis earned a law degree from Hebrew University, clerked on the Israeli Supreme Court, earned a graduate degree from Oxford University in law, and is now currently teaching at Columbia Law School and earning her doctorate in economics at Harvard University. Welcome, Professor Gillis. Thank you for making time to join us in this conversation.
Thank you, and thank you so much for having me.
Hello, I'm Mark Donner, a computer scientist.
And I'm Roland Trope, a national security lawyer. We are your hosts for this episode of Mind the Gap, Dialogues on Artificial Intelligence.
In addition, we have two more hosts.
Hello, I'm Mama Adams, a national security lawyer.
And I'm Charles Palmer, a computer scientist.
Each episode will be led by two of us, with the others adding impromptu questions and comments as the spirit moves them. So back when I first applied for a loan back in the days of the dinosaurs, I filled out a 2-page paper application. Subsequently, I met with a loan officer who talked to me while looking at the 2 pieces of paper I had filled out. How has institutional lending evolved since then?
So I'd say that the institutional lending has changed in many ways. So if we think of we often talk about algorithmic lending, but that kind of refers in many ways to 3 distinct but very much related trends that we're seeing going on today in the world of consumer lending. So the first kind of an important trend is towards automation. So while traditionally a lot of lending decisions involves kind of human discretion and human involvement in the process, so perhaps you'd meet with that loan officer, they would engage in kind of extracting some of that information. Sometimes they maybe would kind of learn something about your credit worthiness or something that might be relevant to the decision whether to provide a loan or not. We see a trend towards all that process being automated, the decision making of whether to give a loan and under which terms happening automatically rather than the human discretion. I think the second trend is relevant to kind of the information that's used to reach these lending decisions. So we can think of kind of traditional lending information, such as credit score information, income information. And to some extent, this is related to the first trend of automation, because traditionally, I think loan officers were thought of as kind of an art in a way of also inferring information about creditworthiness. But today we're seeing kind of much more use of non-traditional data. Now, non-traditional data could be information about people that kind of maybe intuitively seems more relevant to kind of ability to pay and creditworthiness. So that might be information like timely rental payments that today isn't considered by kind of mainstream credit scores. It could be information on cash flow, but also kind of a lot of information that we really would think is kind of non-traditional, perhaps hardest to see its relationship to creditworthiness, whether it's kind of consumer behavior or the type of kind of metadata that you talked about to do with what operating system you use, how you use the mouse, and information like that. And then I think the third trend that's very relevant is towards kind of the use of advanced prediction technologies. So even credit scores use some kind of statistical technology to kind of take information and transform it into some score, some prediction of creditworthiness. But what we see today is kind of use of kind of machine learning and much more advanced prediction technologies, which again is very much related to this idea of kind of the move to non-traditional data, high dimensional data that needs a kind of more sophisticated statistical technique to take that information and to create predictions of creditworthiness that would be relevant to consumer loans.
Why has it changed?
Yeah, that's an excellent question. I think there's two reasons why we see so many changes taking place in the world of consumer credit. The first is that consumer credit, or the prediction of creditworthiness, unlike a lot of domains in which we hear the use of AI, is a domain in which it's actually quite natural to reduce the question to one of a prediction problem, right? It's not in many domains, for example, the use of AI in employment decisions, the use of AI in judicial decisions. Really, you're using a prediction problem within kind of a broader set of some decision-making context, whereas very often in the context of consumer credit and the prediction of creditworthiness, it's quite easy to define it as a prediction problem. And so it's a domain in which kind of these new technologies kind of, to some extent, kind of shine the brightest and perhaps relate to kind of the fact that creditworthiness in the past as well has related to a prediction problem that uses data. I think the other reason why we're seeing this recent explosion in consumer credit is that consumer credit is a domain which traditionally has been very problematic for consumers, particularly in the US. So in the US, where we rely very heavily on credit scores to access mainstream lending institutions, it essentially has meant that consumers that don't have a credit score, consumers who have very thin credit files, have been excluded from mainstream lending. But we now know that many borrowers are very creditworthy, even if they don't have the kind of traditional files. So, for example, the case of consumers that pay timely rental payments, they may be very creditworthy, even if they don't have kind of a mortgage and they weren't repaying a mortgage on a timely schedule. And so when those kind of behaviors that are shown to predict creditworthiness are kind of excluded from mainstream credit scores, it does create kind of this kind of block to access to credit to large segments of the population, particularly kind of more vulnerable or racial minority populations. And so I think that part of the push towards these kind of alternative ways to assess creditworthiness is very motivated by this idea that consumer credit markets currently are slightly broken in the US.
So given that AI accuracy in credit assessment is imperfect, how do lenders know when it is and is not working?
Yeah, so I think that's actually very tricky to know whether a prediction of creditworthiness is actually producing the results that we want it to produce. So for some borrowers, the borrowers or the applicants that receive a loan, one of the ways we know whether we've done a better job at predicting creditworthiness is to see whether, in fact, people who received a loan defaulted or not, right? If the prediction is ultimately whether someone makes a timely payment or defaults on a loan, then potentially we have that information. We learn of the true outcome over time, and we're able to say how good that prediction was. But of course, the difficulty is if we're trying to predict someone will default on a loan, we only learn about that outcome, whether someone defaulted or not, if in fact they receive a loan. If an applicant doesn't receive a loan, then we don't know whether the prediction was right or wrong because we simply don't know the outcome. And that's a big challenge in all domains in which we have prediction problems in which we don't observe outcomes, but it's particularly problematic with consumer lending. So if there's, for example, a certain population that are more likely to be denied credit systematically, we don't have the ability to learn about their creditworthiness over time. And potentially we create the situation in which kind of the predictions themselves are biased by this fact that we're not learning anything about those populations. So it's actually pretty tricky, this question of how we actually learn whether our algorithm is doing a good job or not.
Very interesting point. So there was a recent incident in the press in which each member of a married couple applied for a line of credit from the same institution. The male received a much higher credit line than the female, despite the fact that her income and assets far exceeded his. What do you think this teaches us?
Yeah, so this came up in the context of Apple Card that's issued by Goldman Sachs, and Goldman Sachs' initial response to this accusation that a wife and a husband were receiving different terms is that it couldn't possibly be discrimination or driven by gender because they don't know the gender of their applicants. And so I think the first thing to kind of note about this incident is in a way that was a very unconvincing response. And I think Goldman Sachs experienced that given the backlash that they received after they kind of announced that it couldn't possibly be discrimination because they don't ask applicants about their gender. I think that it was pretty clear to everyone that in of itself isn't necessarily an indication that gender is not influencing the decision. I think the other thing to note about that incident is that it didn't just end with the accusation on Twitter. There actually was an investigation by the New York State Department of Financial Services that looked into it and concluded that there wasn't discrimination. However, that report itself was very opaque. It's very hard to figure out exactly what the reasons were behind its conclusion. And I think it's very important going forward that regulators themselves are also transparent about the types of analyses they're using to establish fair lending.
Charles?
I got to jump in here because this is really scary stuff. But is the U.S. alone here? Is this a U.S. problem, or is this happening everywhere?
So it's definitely not a US problem. So countries all over the world are grappling with this issue of how do we kind of capture the benefits of AI while making sure that they don't discriminate and kind of disproportionately affect populations that are already vulnerable. And so we've seen a lot of initiatives of private companies. We've seen initiatives of non-governmental bodies. Perhaps one of the kind of most important developments that we've seen over the past few months is the European Union releasing its proposed rule for the regulation of AI. So it's a proposed rule; it hasn't been adopted yet, but it's really kind of the most ambitious and broad attempt to regulate AI, and it's very important for our purposes of consumer lending because what the proposal does is it distinguishes between different types of use cases and kind of adapts the level of scrutiny or the level of regulation depending on kind of how high risk that use is. And it actually designates creditworthiness assessments as high risk. So it's definitely one of those domains that we could probably kind of expect that in Europe at least will receive quite a bit of attention.
I'm listening to this, and what keeps running through my mind is that when you're in college or graduate school, your parents or your teachers remind you of how certain behaviors will affect your FICO score. And so you try to model your behavior in a way to improve your credit worthiness, present and future. What worries me from what you've been describing is that if fintech companies start to use things like SAT scores, which when you're taking the SAT, you're certainly not saying to yourself, this will improve my credit worthiness. You're letting AI draw on data that people can't change their behavior to modify and improve. And it creates a different kind of adverse, unintended consequence. So that leads me to ask, fintech companies seem to have access to a tremendous amount of this kind of information about us that we didn't realize that they had. When Mark would meet with his loan officer, he didn't come in with his SAT scores or his IQ tests scores from grammar school. How are the fintech companies getting these data? Do they purchase it? Do they license it? Do they develop it themselves? What's the process? And is the process one that's uniform, or is it itself changing rapidly?
Yeah, so I think that very much varies by the loan type and even kind of the specific firm providing the loan. So there's a lot of variation in the types of practices or the types of information that's being collected under kind of this heading of algorithmic lending. So sometimes information is provided directly by consumers to lenders. And I think a lot of the examples in which we're seeing the use of SAT scores are related to contexts in which we're dealing with populations that may not have a credit score, typically because they're quite young. They haven't had time to build up their credit file, but they nonetheless might be creditworthy, and their use of GPAs or SATs might be a way to kind of signal or indicate creditworthiness when other information isn't available. So it may be that kind of over a person's kind of decades later than when they go to college, an SAT and a GPA may not be the best indicator of their creditworthiness if kind of over time they've engaged in these other kind of either lending practices or payment practices. But very often that information on an SAT or GPA will be provided at kind of an early stage. And very often that will kind of be directly provided by the borrower who's interested in the information. Of course, there are many contexts in which it's not kind of directly asked of the consumer, but rather either automatically collected. So for example, when we talk about use of cash flow or information about the bank account, that might be information that the bank has collected independently of the credit decision, but then kind of uses for its credit decision. And finally, I think another example that kind of sits in between these two extremes of kind of upfront asking for certain information versus kind of it being collected automatically and perhaps unknown to the consumer, a situation in which the consumer will actually allow a lender access to their bank account or to an IRS form, and gather information in that way. And so then there's some kind of automatic process that gets that information, but it's known to the consumer because they kind of provide the permission for that information to be collected.
So as I hear you guys kind of going back and forth on this use of non-traditional data, one point, Talia, that you were raising that struck with me was, while there can be some perhaps negative inferences as we talk about sort of SAT and GPAs and what that means, what I hear you saying, and please correct me if I'm wrong, is non-traditional data inputs can be helpful in this process, but it really depends on sort of the quality and quantity of the non-traditional data or inputs that we're using to assess these credit rules and creditworthiness. For example, you gave the example of if someone makes rent payments consistently over a period of time, that can be a very helpful non-traditional data input. Whereas when we talk about GPAs and SATs, it doesn't seem so natural to us, but that's just one of many, perhaps, that are being used by fintech companies.
Yes, I think that's exactly right. So much of this depends on the quality of the data, and that's something we sometimes overlook. We just assume that that if you're using this information, then the good quality information is out there. But it's actually very complicated. And even in the easier example that I provided of this idea of using timely rental payments, it's really not that straightforward. And so Fannie Mae recently announced that it would use rental payments in their own models of making determinations whether they would guarantee or purchase a loan from mortgage originators. And they are essentially now grappling with this issue of how exactly are we able to verify these rental payments and make sure that we have that high quality information. So yes, a lot depends on having high quality data, and it gets particularly complicated when the lack of quality isn't spread equally among all groups. So if quality was poor across all groups, then lenders would probably say, well, this information isn't very useful. Where it gets tricky is when there's some populations that perhaps the way they pay rent is much more straightforward through third companies, easily verifiable, versus other groups that perhaps don't have it so easily verifiable. And then we have a policy that disproportionately affects different groups.
But there's a question we're sort of jumping over. We're saying that the fintech companies get access to all this data. They're using AI to connect dots that we wouldn't have connected otherwise. But there seems to be a question of, do they determine whether that data is in fact giving them greater accuracy? And second, is it ethically sound for them to be using that data, even if it is accurate? If the data is, let's say, SAT scores again, and there are certain populations that just don't get a leg up early on doing well on the SAT scores, that may not predict, in fact, their success at college, but it may be damaging to their credit worthiness. Can you address both of those questions for me?
Yeah, so at a certain level, we can think of lenders themselves having a business interest in the information being good information that's predictive of credit worthiness. So the first level to recognize is that in some domains, the interests of consumers and lenders might be somewhat aligned in this respect, that we want information that's able to predict credit worthiness. I think there are two important caveats to that. The first is that going back to the point before about the fact that it could be that the quality could vary for different groups. It could be that for lenders, it's good enough when they're able to capture enough of the borrowers and say something accurate about enough of the borrowers. And be less concerned about the fact that they have inaccurate data about some other groups, and perhaps lose out on the profitability of those loans, but perhaps it's not worth the extra effort of making sure that data is accurate. And in fact, that people who study the history of credit scoring in the US, I think that story very much resonates of how credit scores were developed over time. The concern very much with credit scores would be that even if for the majority or the mainstream people with mainstream financial lives, the credit score did accurately capture their information, the concern were always people at the tails. So I think that's the first caveat. The second caveat is that lenders might have an interest in pricing or taking into account factors that from a normative perspective, we don't think that that's okay. So, Roland, you express that sentiment with respect to SATs, but of course, the mainstream examples of factors that that lenders might want to take into account, but nonetheless are problematic from a normative perspective, are all those protected characteristics that exist in our fair lending legislation, like race, gender, age, marital status. And in those cases, we can imagine that a purely rational borrower or lender might want to take those things into account, and yet they're limited in their ability to do it. So business interests alone, right? The business interest of making a prediction that's accurate, because if a borrower defaults, that is a loss for a lender. Business interests alone, I think, don't capture all the things that we would care about from a normative perspective when it comes to this algorithmic lending.
This sounds very worrisome to me, because I think of AI metaphorically as a kind of black box. And now the lending practices seem like a black box surrounding that black box. So to ask about that second kind, do fintech or financial companies disclose how they verify the accuracy or completeness of the information they're obtaining and using with their AI systems?
So this again varies by loan type and loan institutions. sometimes with larger loans like mortgages, the verification of consumer information is a very, very important factor. So I could report my credit score, I can report my assets and my income, but then that would have to kind of be very much verified by the mortgage originators. And there are a number of technologies that are now being used in that verification process. And that will kind of extend to some of the information that's obtained, kind of the non-traditional information with algorithmic lending. Of course, with traditional credit reports, you as a consumer can view your report and you can correct your mistake. We still don't have that equivalent mechanism, perhaps in the world of algorithmic lending. But one thing to keep in mind is that there is a requirement in all type of consumer lendings to provide consumers with what's known as an adverse action notice, which is essentially a document that provides some explanation of why a credit decision was taken, such as a denial of credit or kind of a change in terms. And that may provide us in the future with some information that will make us understand more about how these decisions are made by algorithmic lenders.
Mark?
So is there a risk that this type of information might serve as a proxy for protected characteristics like gender or race?
Yes, I think there is a real risk that information will be used as a proxy for protected characteristics and essentially kind of undermine the fact that we're trying to avoid the differential pricing or granting of loans based on protected characteristics. Now, this is something that has always troubled fair lending. So a typical example is the use of zip codes in credit pricing. That has always been suspicious because zip codes are often thought of as a proxy for race. And so this idea that you have to think about how other information becomes a proxy for those protected characteristics has always been a concern. Of course, it's much more complicated when we talk of kind of big data and the use of machine learning. And that's because it's not really about these individual variables that we're able to isolate and recognize them as being proxies, but rather complex interaction between variables that are often substitutable that then form a protected characteristic. So I think this is something that we should be very much concerned about and thinking of how to mitigate this concern.
Could you give an example of what you just described, just because I'm not sure what those variables might be?
That's exactly the point, that it is unclear what those variables would be to some extent. So something I've done in my work is I've taken variables from the HMDA data set. So mortgage originators in the US are required to report information about mortgage applicants. And so I have this data set from the Boston Fed HMDA data set that essentially has all this information about borrowers and the loans that they apply to. And then I asked, well, how accurately can I predict the race of an applicant from all this other information other than race, but pretty fairly standard variables like past credit history, income information, the loan information. So I try to predict race from that pretty standard data set. And I compare that to the prediction of race from zip codes. Again, keeping in mind that zip codes has always been the kind of the archetype for a proxy for race. And I actually find that I can predict race more accurately from those traditional loan variables and borrow variables than from zip codes. And I think that should kind of that should worry us that in the interaction between these variables, we're able to kind of reproduce these protected variables in a way that's even more accurate than what we've always kind of traditionally thought of as classic proxies.
So in 2002, Andrew Pohl, a statistician working for the retailer Target, developed a remarkable technique for predicting when a household included a pregnant woman purely by scoring a variety of purchases. While we know that the predictions were disturbingly accurate, we don't know what percentage of the pregnant women in the target audience it actually found. Can we appropriately shield protected information in the output of processes like this? How might we achieve that?
Yes, so the example of whether a woman's pregnant or not is a really fantastic example of what I was suggesting before, that where things could kind of go wrong is when we don't actually observe the outcome, and we don't have that feedback loop or that new training data that we can use to then form kind of better predictions. And so if Target doesn't know ultimately about whether they actually were able to target pregnant women or not, then that will, put into question of kind of how accurate this algorithm was, and whether they can train, if they wanted to train, or if we wanted them to train a more accurate algorithm, whether they'd be able to do that in the future, because they essentially, in many cases, won't observe the outcome. But I think also one of the things that this example of Target clearly shows is that it probably wasn't a particular product or kind of one individual feature that was kind of indicating to Target this is a pregnant woman, but really kind of the interaction of products that perhaps each individual product is bought by many people who are not pregnant women. And so I think that idea kind of that was early days of kind of thinking about that, but that would very much play into kind of in algorithmic lending nowadays. I think that the question of how we might shield ourselves against that situation, assuming that we don't want Target to learn or act or treat people differently based on whether they've managed to predict that someone's pregnant or not, is quite a complicated question. But I think the key takeaway, in a way, from the Target example is that telling Target not to use any individual purchase or individual behavior, probably in of itself in isolation, would not greatly impact that prediction that they were making about kind of the status of the women.
So this sort of a key question. You titled your article "The Input Fallacy." Can you explain the title and give us the gist of the argument?
Yeah, so the article focuses on the fact that many of the kind of policy proposals that we see, both by researchers but also by governmental organizations, have kind of focused on what I call input-based approaches to regulation of AI. And that essentially means policing the inputs that go into an algorithm as a way to guarantee that outcomes are fair or non-discriminatory. So that policing of inputs may be through saying, let's make sure you don't include a protected characteristic as an input. It might be through saying, let's make sure you don't use a proxy as an input, or just limiting the types of information that can go into an algorithm. And so the focus of the paper is essentially saying why this kind of input-focused approach is misguided, both because it's likely to be ineffective, for some of the reasons that we've discussed, because when a protected characteristic can be inferred from other variables, or and where proxies are not easily identifiable and we can't isolate them, then thinking that we are able to kind of guarantee non-discriminatory outcomes through this process just simply isn't true. But also it's potentially harmful, and it's harmful for a few reasons. It's harmful, first of all, because sometimes we actually want to be race aware when it comes to fair outcomes. Now, this is quite radical, perhaps within our current thinking of discrimination, which obviously sometimes is characterized by what I'd call kind of a myth of algorithmic color blindness. This idea that when we exclude these protected characteristics, we've kind of guaranteed non-discriminatory outcomes. But then very often there's types of information that should be interpreted differently for different groups, and perhaps being kind of more race aware or gender aware when we develop these algorithms might lead to kind of more equitable outcomes. The second reason that it's potentially harmful is that we have a lot to gain through the use of alternative data. As I mentioned before, consumer lending really doesn't have a very good history in terms of excluding certain populations from mainstream credit markets. And so actually the potential for using alternative data to expand credit is a really important benefit of AI and machine learning. And so we really don't want to kind of let go of that benefit, given that the status quo is not one that we should be proud of or hold on to.
It sounds like you're also advocating for avoiding premature regulation of an industry that's still trying to figure out what it can do best. Charles?
Yeah, I agree with that. So one of the, you raised a very good point, is that, and we find this in other areas of machine learning as well. You just, whatever data you've got, you pour it in and see what comes out. So the good news is you may get really good results. The bad news might be as far as the explainability. When you come back and say, all right, that's really cool. What did you use? And have you had questions and situations where people ask, how did you do that? And there was really no way to know?
Yes, I think the explainability is a key concern. And it's both a concern for consumers who want to understand credit outcomes. And as I mentioned, there's regulation that requires that lenders provide consumers, that requires that lenders provide information to consumers. But there's also the explainability to the regulator, right? If the regulator is monitoring and overseeing fair lending, then they also need to understand kind of what's going on and whether outcomes are okay. And so I think explainability is a real challenge. One thing, though, I think that's important to remember is that there are a lot of questions that we care about that aren't necessarily about opening the black box of AI, but really the broader decision-making context and the actual outcomes of decisions. So we may learn a lot about kind of the outcomes of the use, for example, of cash flow data, just by kind of observing the outcomes of an algorithm that kind of prices based on cash flow data. And so if you're a regulator, maybe that's what you truly care about and not necessarily exactly the type of model that the algorithm used to produce that outcome. The second thing I'll mention is that there are a lot of other questions that I think we really would care about that are about how we set up the algorithm and not necessarily what goes on kind of inside the algorithm or the black box. So just to give you one example, we've focused so far in our conversation on the use of AI to predict someone's credit worthiness, whether they'll default or not. But very often in credit markets, one of the things that lenders want to know is what's the maximum amount they can charge you for a loan and you'll still accept the offer. That may be to do with kind of the competition you're facing, how financially literate you are, if you're the kind of person who will shop around for a loan. Now, suppose that instead of having a loan officer that I come to and I say, hey, I've got all these alternative offers, and they adjust my price based on the fact that they've just learned I have an alternative offers and I've shopped around. Let's assume an algorithm can do it. They can figure out, based on my shopping history, whether I'm someone who will just accept the first offer I get or will shop around. If I'm regulating fair lending, I might think differently of a pricing algorithm that tries to infer that kind of how much a person is willing to pay for a loan and whether that creates, let's say, racial disparities versus if what they were doing was just predicting credit worthiness. And so as a regulator, I would want to know what was your target variable? What were you trying to predict? And that doesn't necessarily have to do with the black box. It doesn't necessarily have to do with what's going on in the algorithm, but it's how the algorithm is set up. So I think we shouldn't overlook the many important questions that we can learn that don't directly go into this issue of kind of the black box and explainability that the regulator nonetheless would very much care about.
So yeah, based on my shopping history, I am one that shops around, and that would be very clearly figured out and defined. But one thing I was picking up, and I'd be interested in your thoughts on this, as you were kind of talking about the inputs, the decision making, and the outcome, right? And maybe in some instances there's been more of a hyper focus kind of on the inputs, but perhaps depending on the situation or the scenarios where you're using these types of algorithms, the balance between those three could be different, right? Depending on what information or what predictions you're trying to make, the types of data that's available to you, sort of that correlation between input, decision-making, and the outcome analysis could be different, and that's okay.
I think that's right. I think that, although I kind of warn against this over focus on the inputs, I think it would be kind of naive to overlook the fact that we care very much about what information is used to make different determinations. And even if there was some relationship between a certain input and creditworthiness, it might not mean that it should be used. That could be true for privacy reasons. Perhaps we're concerned about kind of information from other domains kind of then being used in new domains. That might be a concern if we're perpetuating some kind of pre-existing disadvantage in one domain in a new domain. It could also be relevant just for the trust in lending institutions. So I think there are reasons to think about those inputs. I guess my bigger concern would be to kind of too heavily rely on that input scrutiny to get us the kind of results that we want to. But also kind of this idea that there is some real and concrete gain to be made from expanding what kind of inputs we use for these decisions.
So I'm intrigued by something that your entire thesis suggests to me, which is one of the challenges that you highlighted earlier on is that we don't know what the outcome would be if we gave a different answer. And as a result, we can't really improve things over time. I could imagine that in addition to regulatory sophistication suggested by some of the things you said, one could construct what I'll call an insurance program, which works basically like this. It's funded by Fannie Mae, Ginnie Mae, something like that, that basically says, look, I'm going to ask for a dial that lets me, the government, increase your risk tolerance. In exchange for that, I will buy some of your failures. I will make you whole for some percentage of your failures in exchange for being able to see as a regulator the result. So that will then let us as an industry, not me as a particular lender, will let us as an industry learn how to improve the outputs, okay? Rather than basically say, well, all I can work from is the inputs, okay? Is that something that one could put together? Does it make sense?
I love that idea of creating some mechanism to learn about outcomes. And I would add to that idea that to some extent, we should incentivize through this program random lending that isn't informed by creditworthiness predictions at all. It's completely random because through that randomness, we typically think of noise as a bad thing, but through that randomness, we might potentially learn a lot about these populations that in just using the algorithm again and again and again, that's providing the loans to the same types of population again and again, we're just simply not learning. And so I do think that is a form of that idea, I think has to be part of how we think about this type of algorithmic lending going forward.
Talia, we haven't asked you what we sometimes ask guests, which is what is it that brought you to be interested in AI? And yet you've written this article, and I congratulate you getting it published in Minnesota Law Review. That's really exciting. What are you what audience are you hoping to reach, whether it's policymakers or others, with the article? And it would be helpful to know, as both a lawyer and an economist, what drew you to be interested in it and to learn about AI?
Yeah, so I, as you kind of mentioned in the beginning, my training is in economics, which we don't traditionally think of as a discipline that uses kind of machine learning, which is very much a prediction tool, as opposed to a lot of the techniques we use in economics, which are about causal inference. But something that was taking place during my years as a doctoral student in the economics department was a lot of inquiry and thinking about how we use these advanced statistical techniques in some of the empirical research that we do as economists. And key to that was understanding in what ways machine learning is different than, let's say, a linear regression that's used by economists. And that kind of, I'm going to call it soul searching because it often did feel like soul searching. That soul searching occurred to me at some point, that's very relevant to policy and how we regulate algorithms, understanding how this technology is different than what we've been kind of familiar with over the years. So if traditionally kind of credit scoring used more standard kind of linear regressions, what does it mean that all of a sudden credit worthiness is assessed using machine learning and big data? And that I think very much kind of motivated me to explore these ideas in my legal work about the regulation of AI. I think that I would say the primary two audiences for my paper, both kind of policymakers and regulators and other legal scholars. To go back to something that you mentioned before, Roland, about the risks of premature regulation, I think we're facing another risk, and that risk is that there's so much uncertainty from alternative lenders with respect to kind of what fair lending means and how one would kind of comply with fair lending, that I think to some extent it's preventing a lot of beneficial innovation in the space. And so while we need to keep in mind that kind of premature or problematic regulation isn't going to help things, we also, when there's a lack of guidance and some kind of key questions, it also kind of, we get an industry that's a little defensive. And that happens with financial institutions, right? Financial institutions are heavily regulated. Sometimes they tend to be more kind of risk averse. And so we're currently in the state where there isn't kind of much guidance coming out, both in the US, but also in Europe on issues related to kind of algorithms and fairness and discrimination. And so I think my audience, when I try to speak to regulators and policymakers by saying, look, we need to have some kind of understanding of how this would be analyzed, but inputs is probably not the way, and we need to kind of think of alternative ways. But I'm also talking to legal scholars, and I think kind of our responsibility of legal scholars as kind of we think through these challenges is really not necessarily to go with our first instinct of what kind of perhaps feels the cleanest or kind of the most related to kind of traditional analysis of fair lending, which I think is input analysis. I think it would be pretty fair to say that traditional fair lending analysis was very much kind of focused on the inputs into the decision. And so I think as legal scholars, we need to be getting a little more creative in how we think about these kind of legal issues that arise in this context.
Well, I think when you talk about, what difference does AI make, that's going to be something of interest to all of our audience. And I, in reading your article, was very impressed by how sophisticated and nuanced your approach was. You didn't say the immediately obvious is the end of the answer. You came back and said, well, that may seem to be good, but now look at it from another angle. So let me do that. Let me kind of lift up a rock and see what's underneath it. And it may make the financial institutions a little defensive to be asked this question. But from your perspective, social media companies say they do not collect protected characteristics. But recent revelations in the press suggest that they can target protected groups with shocking precision and accuracy. Is this same issue, or is this the same issue that you identify in your article, or do you come at it a different way?
Yes, I definitely think that this focus on do you know or not know a protected characteristic really should not be the focus of any analysis of considering whether protected characteristics are actually used in decision making. In fact, I also think that there are many contexts in which it's beneficial that protected characteristics be collected for the purposes of analyzing disparate impact. So if disparate impact, which is a doctrine, a legal discrimination doctrine that deals with policies that on their face look neutral but may have a discriminatory effect, it's very hard to analyze unless you have information about people's protected characteristics. So I think to some extent, not only is it insufficient to say we don't know protected characteristics and therefore our pricing, our decisions are not problematic, but in fact, in many ways, we should be requiring the collection of protected characteristics to put in the correct kind of safeguards and mechanisms that we need to examine things like fair lending. Now, it's in the US, mortgage lenders are required to collect information about race, because as I mentioned, that's something that's reported, applicant information, including race. But that's really a kind of an outlier in consumer lending. It's just kind of mortgage lending.
Well, you remind me in what you've just said that discrimination is obviously not usually a good thing. It's usually not. But bias is a term that we need to keep neutral, because in the AI context, it may be important to have intended bias that has a positive outcome, to get certain imagery to focus on malignant tumors and not other kinds of growths. That's not a bad bias. And I think it's important to keep bias as a neutral term when we're in the AI context. Mark, you look like you had a question.
So moving on to the sort of last sort of wrapping up process, when you think about if you can't manipulate or control the inputs, then the only other place is the algorithms and the outputs. So that made me think about the output question. So let me take as an analogy the Postal Service. The Postal Service is not physically secure. It doesn't really try to be physically secure. Nonetheless, everyone trusts it with highly sensitive information all the time. Why do they do that? Because the penalties for violation are severe, they're known to be severe, and they're vigorously enforced. Is a model like this applicable to consumer lending?
I think what's key in the example that you give of the Postal Service is there's essentially a negative behavior that we can easily define that we want to deter. So the use of kind of high sanctions is to kind of to deter that the definable and potentially verifiable behavior. I think what's tricky when we talk about kind of fair lending is, I think in most cases, the concern is not intentional discrimination in the sense of animus towards a certain group. I think in many ways, kind of what maybe traditionally was a concern in which kind of you have a loan officer that would feel some animus towards a certain group and kind of price differently based on that. I think that to a large extent, the use of kind of automated algorithms may alleviate some of our concerns in those domains. So I think that when we talk about what concerns us with fair lending, it's not to the same extent that kind of intentional kind of animosity towards a group. I think what's tricky, therefore, is kind of to define what exactly and under what circumstances is a pricing algorithm leading to an outcome that we don't want. And we're still missing a lot of that definitional piece and a lot of the guidelines with respect to how do we define that problematic behavior. Before we even kind of impose very strong sanctions, we need some sense of how we define that problematic behavior. And I would say that's kind of, I think, a lot of the ambiguity that we live in at the moment, that we don't have those clear definitions of what we're after. Now, once we do, maybe the right next step is kind of severe sanctions for violators. But I think that we're stuck to some extent on that first step.
And I ask also, when we are making determinations about intended or desirable outcomes, is AI at the stage yet where we can design it not to generate unintended or undesired outcomes? Because that problem has always been attached to designs of software. You can design software to generate desired outcomes, but it's often difficult to design it so it doesn't generate undesired or unintended outcomes. Won't that same problem reoccur in AI? And don't we have to worry about that once we define the intended outcome?
So I think part of what's tricky is that what is desirable or not can vary on the situation and can be somewhat contradictory. So just to give you an example, if, let's say, a 25-year-old man and woman were to kind of go to a mortgage originator, apply for the same loan, let's assume they went to the same college and they studied the same thing and they have the same job and they have the same income. So everything at age 25 looks the same other than their gender. And let's say we were setting up an algorithm to predict their income in 20, 30 years. So mortgages, they have a long horizon. And so a big part of what you want to know is kind of what will the income of this person be in kind of 20, 30 years. So let's say we set up an algorithm to predict their future income. Now, and I apologize for the personification of an algorithm, but an algorithm might really want to know their gender, right? If we have labor market discrimination, if women are less likely to be promoted, if women are more likely to kind of take a step back in their career after having kids, then actually a person's gender has a direct relationship to that prediction of their future income. So we say, hey, algorithm, predict future income. Now, from the perspective of the algorithm, a desirable outcome or desirable prediction uses gender in reaching an accurate prediction. But from a normative perspective and from a legal perspective, we can't price differently for a man and for a woman. And so this issue of how do we deal with these two opposing goals in which there's something that's empirically relevant to assessment of creditworthiness and a future income, but we don't want pricing to differ along that dimension. It's a very complicated question of kind of how we set up an algorithm with these two potentially contradictory goals. And so one approach, and I think one that makes things a lot more transparent, is saying, let's predict creditworthiness and let's impose these constraints if we see these differences between how women and men are treated by this pricing algorithm.
So to wrap up, AI is a rapidly evolving field. All of us, including both technologists and policy people, are working hard to keep up with the changes. What most concerns you about the future of AI, and what most excites you about its future?
So I'd say my largest concern, and this is, I think, a concern I share with people who work in other domains, kind of outside consumer lending, is that this kind of ability for better prediction or more accurate prediction could cause raise serious distributional concerns. The moment we can better distinguish between different people, those people that benefited from the lumping together with other people, the less granular predictions. And so we have, of course, the kind of classic discrimination concerns that we've discussed, but they're distributional concerns that just have to do with the fact that we may kind of increase gaps between those people at the top who are going to get very beneficial terms, going to get loans, and those that now, because maybe we learn more about them, but they kind of end up in the situation in which kind of they no longer have access to credit or kind of have access to worse credit. And it's very important to keep that in mind when we think about kind of access to credit, because credit terms or getting a loan is not only reflective of your current assets or your current wealth, but to some extent, it's a producer of future wealth. And so we want to be very sensitive to the situation in which kind of we're potentially perpetuating a situation of disadvantage that pre-exists, even when it's just along social economic lines and not kind of protected characteristics. So that's, I guess, what I'd be somewhat concerned about. But there's also a lot that I'm optimistic about the move to algorithmic pricing. Some of it has to do with what we've discussed, this idea that potentially through considering a broader range of characteristics, a broader range of kind of aspects of people's financial lives, we're potentially allowing or including people within certain markets that they've traditionally be excluded. But I'm also, I think there's reasons to kind of be optimistic for other reasons as well. I think that a lot of traditional lending has happened in a very opaque way. So we've talked about an algorithm being a black box, but one can't imagine a bigger black box than the human brain. And in a world in which kind of loan officers were making decisions about credit and decisions about loans, we really didn't know much at all. Perhaps they provide an explanation, but you'd have to even trust the explanation they provide. And so I think that there are real gains in transparency through a world that operates with automation, in which we kind of can learn a lot more about what's going into these decisions and how these decisions are made. I also think that related to this transparency, there's a lot of potential for prospective testing of different algorithms or the use of different inputs. So in a traditional kind of lending situation, we might not have a sense of whether kind of a practice was leading to some kind of unfair outcome or discriminatory outcome until a decision-making policy was actually implemented and people actually received loans or were denied loans. In an algorithmic setting, we can perhaps learn a lot about the effects, distributional, discriminatory effects ahead of time through prospective lending. And so there's a lot of opportunities to learn more at an earlier stage. And I think for regulators to know and learn and regulate in a much more kind of effective and informed way. And so I think that's a real promise.
Well, let me say, I seldom hear somebody who has thought as long, hard, and clearly as you obviously have done, given the answers to the questions, only some of which you saw in advance and many of which we sprang on you. It also makes me wish that you were teaching at Columbia online, even though it's in the same city as I am, because I would like to sit in. And I think I would find that really worthwhile. You've been very generous with your time. I still don't know how you do all that you're doing, both the doctorate teaching and raising, with your husband, 3 children, 2 of which are twins. To me, it's a balancing act that I find really admirable. But I would also just like to thank you for taking the time and being willing to accept an invitation to talk to all 4 of us, because I, for one, and I think I'm not going to put words in anybody else's mouth, I thoroughly enjoyed this conversation.
Thank you so much.
Wonderful.
I really appreciate these questions and comments, and it's given me a lot to think about. Thank you.
The views expressed in these podcasts are solely those of the speakers and not of their employers or organizations. We thank the American Bar Association for their generous sponsorship and support of the production of this podcast. Our theme music was composed and performed by the very talented Ben Rosenblum. We welcome questions and comments from listeners. Send email to comments@mindthegapdialogues.com. We read all comments and questions and will try to respond in the letters section of a future episode. If you are writing about a particular episode, please do mention the specific episode number. Please also do include pronunciation tips to help us properly say your name when we reply in a subsequent episode. See you next time on Mind the Gap Dialogues on AI.
Thank you for listening to the ABA Business Law Section's podcast series, To the Extent That. The section offers a robust collection of content. To explore more about this topic, or to learn about joining the section, visit ambar.org/bizlaw. That's BIZLAW.